After the banking regulator RBI imposed a ban on the services of Paytm Payments Bank, Paytm's share saw a sharp initial decline before trading within a range. However, it's worth noting that a significant portion of the company's revenue came from this business. So, after the main part of the business model is removed, why are people still buying Paytm shares? How will Paytm's valuation be determined? What value are brokers giving to Paytm shares after RBI's major decision? And how should a strategy be devised for this stock now? Today's video will cover all these aspects. On the evening of January 31, the RBI had imposed a ban on credit and deposit transactions related to Paytm Payments Banks. In addition, services like Paytm's wallet, FASTag, and National Common Mobility Card (NCMC) were also banned from February 29. According to the order, the bank's customers could withdraw the remaining balance from their savings bank account, current account, prepaid instruments, FASTag, NCMC, etc. without any restriction. But no transactions could be made from March 1. However, this timeline was later extended to March 15. In fact, Paytm Payments Bank used to provide nodal accounts to Paytm, and the company held the deposited amount for various payment services including digital wallets in these accounts. Following RBI's decision, the company stopped all its transactions with Paytm Payments Bank, which is PPBL. The company has applied to become a third-party app provider, TPAP, which has been approved by NPCI. This will allow the company to continue offering payment services like PhonePe and Google Pay. For this, the company has entered into agreements with 4 banks, namely SBI, Yes Bank, Axis Bank, and HDFC Bank. In this way, the company has managed to save its payment services business with about 40 million merchants and 100 million customers. However, it is now giving cash back to retain monthly active users or MAU and may offer discounts on monthly rent to keep merchants using payment devices, which could impact the company's cash flow. Moreover, there is a possibility of a decline in the volume and value of UPI transactions in FY25. Additionally, a sharp decline in income from the high-margin wallet business could also affect processing margins. So, what impact has RBI's decision had on the company's shares and business, and what changes have brokers made in their opinions and targets for the shares after this? Before the action, Paytm's shares closed flat at 761.2 rupees on January 31. But for the next 3 days, the share continuously hit lower circuits. On February 6, the share even slipped below 400 rupees, and on February 16, the share touched its lowest level so far at 318.05 rupees. In fact, after RBI's action, brokers have made significant changes in the rating and target of the share. The reason behind the reduction in brokers' targets is the changes in Paytm's SOTP or sum of the parts valuation. Through SOTP valuation, the value of each business segment and subsidiary companies is added together to evaluate the share price. Let's understand this with an example. After the fourth quarter of the FY23 results, about a year ago, Citi had valued Paytm's SOTP at 1,144 rupees, which included 430 rupees for payment services, 516 rupees for financial services, 78 rupees for commerce and cloud marketing services, and 120 rupees for net cash and investments. After the RBI's decision on January 31, Citi reduced the target price of the share to 550 rupees with only 200 rupees for payment services, 145 rupees for financial services, 90 rupees for marketing services, and 115 rupees for net cash and investments. This means that the value of payment services has been reduced by more than half, and the value of financial services has been reduced by almost 3/4. These two segments contribute 75 to 80% to the company's total income. It is worth noting here that from September 2020 to March 2023, the contribution of financial services to income increased from 5% to 20%, and the margins of this business remain between 70 to 90%. During this period, the share of payment services in income decreased from 71% to 62%, but the margins increased to around 40% from below 10%. After the RBI's decision, the number of UPI transactions of the company in February decreased by 7.6% from 1.44 billion to about 1.33 billion, resulting in a drop in market share from 11.8% in January to below 11%. In August last year, it was at 12.8%. On the other hand, competition from companies like Google Pay and Jio is continuously increasing, which are now also launching sound boxes. Therefore, most brokers have reduced their target for the share. According to Avinash Gorakshakar, Director of Research at Profitmart Securities, the ban on PPBL will last at least 3 to 4 months. One should not make fresh purchases in the share until there is clarity on this matter. If you have bought the share at higher prices, you can hold it. Overall, considering the increasing competition in RBI's actions, the best strategy for now is to avoid Paytm shares because the lack of clarity on a significant part of the business has significantly reduced brokers' confidence in the share.